Good afternoon, fellow investors, and welcome to another Brick by Brick presented by Parvis. And today we have a special guest, Mr. Dan Stewart from Equivest Capital. This content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any of our presentations shall be construed as a recommendation or offer to sell or solicit of an offer to buy any particular securities. So just as a gentle reminder, if this is your first time with us, Parvis is a technology-driven real estate market investing platform and exempt market dealer. We bring institutional quality real estate investment opportunities to eligible and accredited investors, making the process as simple and as quick as possible. For more information, please visit us at parvisinvest.com, and we'll be happy to answer any of your other questions and happily get you invested in some amazing opportunities, such as today with Equivest. So that being said, I have yet to hear all about the fun things that Equivest has been doing for their investors. So I will pass it on to Mr. Dan Stewart, and he will go through his presentation, and I will gladly ask a lot of probing questions to make sure that they're doing all the right things for us. So welcome, Dan.
Thank you so much. And yes, that was a good little welcoming note there from you. So yes, thank you very much for having me. Can you guys see my screen perfectly fine? We're all good here? You can see that, Michael?
No, I do not actually. Hang on, let me stop my sharing. Here we go. Excellent.
Ah,
Perfect.
okay. Yes, perfect. So, Equivest Capital Partners. My name is Dan Stewart, and I'm the Vice President of Private Capital Markets here. So, large part of my job is raising capital for some of our projects, but today I'm just going to tell you about our private equity firm and exactly how we operate and our opportunity that we provide to our investors. Equivest Capital Partners is a private equity firm that's based in Burlington, Ontario. And the team is comprised of 55 plus years worth of experience in real estate development, project management, and finance as well. So today I'm going to tell you about the company. I'm going to introduce you to our team of executives. I'll tell you a little bit of our two different offerings that we have right now. I'm just going to keep it simple. Instead of talking about all three of our funds, I'm going to talk about the development fund and then the income fund. So we have both a equity opportunity and a debt opportunity that is available for investors. And in light of all the recent stock market volatility, some people are looking for the protection of the assets of real estate and real estate associated types of investments. So I'm excited today to tell you a little bit about us and how we operate.
Excellent. I look forward to it.
Next one. There we go. Okay, so I will tell you today who is Equivest, how can we add value, the income fund offering, which we refer to as the debt offering that's based off of private lending, the development fund offering, our development sites that we are targeting, and summary conclusion, and then questions at the end. So this is our team of executives, starting with the gentleman on the left, Ali Naimpour, who is our CEO. He is a top-ranked realtor that has been very involved with real estate and real estate development. He has transacted more than $1 billion worth of real estate. He's an absolute expert when it comes to land assembly and large-scale real estate syndications. And that's how this firm came to be, was because he has always had the same sort of 5 to 10 different investors that will go in on a syndication basis on a specific property with a plan to buy and hold or some other type of execution strategy, and then sell it at the end with profits for everyone involved. So the only way to scale is to bring it into a private equity firm where not just hundreds, but thousands of investors can participate in a passive fashion with their registered funds. He has a lot of experience working with high net worth individuals and maximizing portfolio returns as a result. And he's got very deep industry network and strategic partnerships. So he's worked extensively in the past with some large scale real estate developers like Live Communities, Los Angeles Homes, just to name a couple. And as a result of that, we do have some really amazing connections to be able to acquire properties before they hit the market at favorable prices. And obviously, using any other contact in any other way is very useful in this space in many different ways. Our COO is Sam Risby. He comes from the healthcare space, and he's actually still active in the healthcare space. So if you're familiar with Nurse Next Door, he did build up that company, and he's exited that now, and he's built up his own now that's called Be Home Nursing, and he's now got 250 PSWs that are working for him, all based in Southern Ontario. And this is like a senior at-home healthcare type of business, but he has an absolutely incredible track record of operational and management success. He has built up multiple different companies to multi-million dollar level. So he is a part of our management team to be able to get involved in some of the day-to-day operations and making sure that we are executing in our plans very successfully. He's a very, very seasoned real estate investor himself. He has multiple different properties that are encompassed across Canada, England, and Dubai. Moving over to myself, I am the vice president, and I have more than 17 years of experience managing a large portfolio of high net worth individuals. I've been personally invested in this space for 8 years. As a result of being in this space for that amount of time, I have seen some incredible returns associated with this market. And that is what made me so passionate about real estate investing, and also private equity. So I joined forces here with the rest of my team of executives, and I'm excited to be in this space because it really is quite amazing how many people don't know about this space, and I love educating about it. Paul Mills is our CFO. He has his master's in accounting. He began his career at Deloitte, managing a diverse range of public audits, and he has built and managed more than 10 different investment funds. So this gentleman has managed actively more than $300 million worth of investment funds. So he has built the entire blueprint and framework for our entire company. Chelsea is a part of our investor relations, and she has extensive experience working with high net worth individuals. She will be keeping up to date with regulatory compliance and market developments as well, and be essentially the main communication hub for our investors as well.
That's a lot of experience in that group.
Thank you very much. Yes, we pride ourselves upon that. So these are the multiple different ways that we add value. And some of them aren't completely unique to this space because obviously with all your options on Parvis, there is a little bit of overlap there. But we find that it's very, very important to point out some of these things for some people that are new to the space. The first one is my favorite one, which is leveraging real estate as a hard asset. So what does that mean? What we're doing is we're taking real estate and we're bringing it to the next level of valuation. Usually that's with real estate development, but there's other activities that are included with that. So there's a massive amount of upside potential, but we also describe this as the downside protection. So when we engage in a property, we don't own the property. The fund owns the property. And that is what we describe as the downside protection. Absolutely, as an asset that's acquired, it's not owned by us, it's owned by the fund. We focus on acquisitions that have a very strong potential for increase in value. Usually this is through development. But how do we do that? We carry out very rigorous due diligence to ensure that we are engaging in the appropriate property. What does that mean? That means focusing on secondary and tertiary markets that have a high amount of population growth and also a lack of housing. This is not necessarily a build to sell strategy, but part of our portfolio strategy is a build to rent. Some of these markets have very high demand towards rental, and they have less than 3% worth of rental vacancy. So a build to rent strategy is something that's very important within this fund because there's an affordability challenge right now. And with all the immigration that's happening and the migration to some of these secondary areas that are more affordable, you're seeing way more demand for that. And we're projecting further demand as we move forward over the next 5 to 6 years. We take a very active, hands-on approach with absolutely everything that we do. So we ensure planning, sales, and construction are all completely optimized for success. We constantly monitor market conditions. We have a team of realtors with boots on the ground every single day. And these people that are out there, they're kind of letting us have a finger on the pulse of the market trends and everything that's happening. We utilize our networks and connections to engage in off-market deals. That's a very important part of this because anyone could just hop on MLS and pick up a property. That's sometimes good, but engaging in a property before it hits the market at a favorable pricing and terms is very beneficial for the long term in any sort of real estate acquisition. So that's a big part of our execution plan. Clear exit strategy for every single asset is very important as well because we make sure that we have a very clear set plan with multiple different levers at our disposal to be able to execute with very strong returns for all of our investors. So now I'm going to talk about the debt offering, which is the income fund. So this is a fund that is a pool of mortgages, land loans, and construction loans that provides monthly cash distributions that are totally separate from stock market volatility. This is an 8 to 12% steady annual average return. And I just made the note here that it's basically 3x the return of a current GIC. GICs you're seeing right now anywhere between 3-4%, that type of thing. So you can get way stronger returns for something that is very rigorously underwritten. And we engage in we deem this as much lower risk because when we look to deploy capital for a mortgage, for example, it says it doesn't exceed 65% loan to value. We do go up to 85% if everything else is absolutely crystal clear and we deem that as an appropriate opportunity. But in general, vast majority are not exceeding 65% loan to value. So
You would
this
say your average is about 65. So you might
correct.
have some that are over, some that might be under. Okay, that's good.
Exactly. And so we set this up as a 3-year holding period. The reason why we do that is because what we want to do is be able to engage your capital in more than just one exposure. So if we have the opportunity to put in 2 or even 3, that allows it to compound and grow accordingly. So that's, how you get into that 8 to 12% range. A lot of the opportunities we're seeing now are more in the 8 to 9% range. But if you do the dividend reinvestment, and then you keep it for the 3 years, you're going to see a way stronger average return over 3 years. So we see constant market demand with this type of opportunity, and we can deploy capital immediately.
Oh, excellent. So most of your lending strategy is like a year or less on approximately,
Yes,
typically.
as little as 6 months.
Okay.
We have had a couple times where you're doing like a bridge loan for 3 months. Typically, we steer away from that because we want to have it engaged a little bit longer than that.
Yeah.
So normally 6 months all the way straight through to 18 months is the typical engagement with what we have available.
Okay, excellent.
So now I'm going to tell you about the development fund, which allows individuals to invest passively like they are a developer. So again, registered fund capable, RSP, TFSA, LIRA, you name it, it's all available to passively invest like you are a developer. Our structure is a mutual fund trust, and we have this set up as a general partner and limited partner. And we have a preferred return for our limited partners. So it's a 80-20 setup, which means that 20% of the equity is owned by Equivest, then 80% is owned by the limited partners, which is the passive investors. So when it comes to the profits at the end, when the project comes to full fruition, the first entire 8% is the preferred return for our limited partners. In private equity, there's something that's called a 2% catch up. So between 8 and 10%, that's Equivest's profit. Beyond 10%, we're splitting everything 80-20. So why is that important? We're not taking profits from dollar one. We're giving the preferred return to all of our investors. With real estate development, it is more of an illiquid type of investment. So how does your investment grow? Your investment grows when we achieve site plan approval with a site, then we have shovels in the ground, then we've got foundation laid. Every step of the way, your investment's growing, but you're not realizing the profits until the project has come to full fruition. So we always say just be comfortable with the capital being in there for a 5 to 6 year period to start to see some of the returns that we're able to achieve in this fund. We have multiple different exit strategies that we execute and have executed successfully in the past. As an example, one thing that my business partners have done is acquiring a site, working with the city, and then achieving site plan approval. And sometimes there's so much market demand with developers that you can actually have a healthy amount of margin difference between acquisition price and what the current market value is with SPA in hand. Then you can just sell it to a developer. We've had some really strong success with that in the past. That's not our goal. That's not our way that we engage forward. What we want to do is do a full-blown development with the maximum amount of return on investment for everyone. So that is something that we execute if we deem the opportunity appropriate to be able to achieve strong returns in a shorter period of time. But in general, what we look to do is bring a project to full fruition.
Nice. So typically, when you have a development project, do you offer sort of milestone updates to investors, and with those milestones you get reevaluations done, or
Absolutely. So what we
okay,
do is every 6 months, we have a clear update for all of our investors with what's happening with the fund. And we make sure that we are giving everyone the opportunity for any questions that they might have. But in general, what we're doing is we're keeping up to date with the investors every 6 months. We think that that's appropriate amount of time because usually with real estate every month, that's probably a little bit too quick.
yeah, too much.
Every year, I think maybe is a little too short, or sorry, too long. So it's like every 6 months, I think there's enough to talk about to be able to share the information.
Okay. And then at major milestones, do you have like a third party audit that sort of reevaluates the value of the current, I guess, the development itself? As an example, if it's say a blind pool when you first get started, then you acquire the land, then do you reevaluate at that point, or you wait till you have shovels in the ground for a reevaluation type of thing?
Our auditing is done by RMR, and they do it on I have to check on this. I'm pretty sure it's an annual basis. They do all of our auditing. But yeah, we would share that information as soon as it becomes available as well.
Yeah, perfect. So
So,
I know investors like to keep track of their dollars. They're like, it has sit at a dollar forever. What
oh,
for
I
example, right?
know. Yeah, and sometimes, yeah, with development, it
So when
does
you can
take.
give them an update and say, well, your dollar is now worth $3 because we've done this, this, and this now. And
Right.
then now you still have another 2 years to wait for your dollar to be worth $7. And then you can cash it,
Exactly.
right?
Yeah. So we make sure that everyone's up to date with any sort of status change in the fund. But yeah, we prioritize that for sure.
Excellent.
So this provides diversification. So with a fund model, you're not just succumb to one single property's success, but rather multiple different properties. So we are focusing on areas like Brantford and Cambridge and secondary markets where there's a very strong amount of population growth and also a shortage of housing. We're seeing a few different trends that are happening, but as I mentioned before, some of these markets have a lot of attraction because they are a little bit more of an affordable housing market. And you're seeing the immigration and you're also seeing migration from some of the more expensive areas. So some baby boomers are selling their multi-million dollar properties in Oakville, Mississauga, Burlington, you name it, and they're going a little bit west to get a little bit more for their money and park some of their money so that they can just retire comfortably. We're seeing that trend as well. Real estate, as we all know, is a much lower volatility type of asset, and it's a direct hedge against inflation. We have an aligned interest because our success is everyone's success. So that's a big part of this as well. And a proven strategy because my business partners have a track record of successful experience in this space as well. So in current terms of current market dynamics, I kind of did already really touch on most of this, but we are focusing on areas that have a lot of urbanization that's happening. That's the part of the benefit of working with some of these secondary areas. Like we get much more collaboration with the city. And what that means is instead of putting up roadblocks and hurdles and things like this, they actually really are encouraging developers to come. So we've been in talks with cities like Cambridge and Brantford, and they are very collaborative towards real estate development, just as like a kind of opposition side. If you're looking to do any sort of development, for example, in Oakville, way more challenging of a process. They make it a little bit more arduous and things can take a lot longer. So we're focusing on markets that are just outside of that. But we focus on also areas that have limited developable land and they have dense real estate dwellings that are all surrounded by it. So really good walk score and making sure that someone could basically live there and not even really own a car. Like you could just basically walk to grocery stores, walk to the park, walk to the school, all this kind of good stuff.
Live like you were in university again.
Exactly. Actually, yeah, that's a good point too, because yeah, there's universities and whatnot that are surrounded in some of these areas, and yeah, it's good to have your properties close to that too. Um, this slide is pertaining to housing stock to population ratio. We all know that we're in a housing crisis. So what does that mean? We took a look at the chart on the top right. Ontario is the lowest when it comes to housing stock to population ratio, and we are projected to get even worse. That provides a really excellent opportunity for our investment thesis. So to tackle affordability with the other challenge that we're dealing with right now is Ontario's housing stock needs to be about 27% higher than current projections by 2030, which translates to about 1.9 million additional homes. That's just simply not going to happen.
Mhm.
But to compound on that, we've got immigration that's happening, and there's still, I think they've actually reduced this by now a little bit, but it was projected not very long ago to be 1.5 million new citizens by 2027. I think they've scaled that a little bit back now. But irregardless, we're in a situation where it's further intensifying the demand for housing. So this fund is set up as a 3 to 5 year targeted annual average return of 16 to 20%. We do like to view it as an equity multiple because when we're taking your capital, we're putting it towards the equity of the properties. And what that it means is that 1.8 to 2.2 is an equity multiple to look at because you're getting paid out as the projects start to complete. So 1.8 to 2.2. So if you come in with 100,000, we expect to pay you back somewhere between 180 to 220,000. We view this as a very exclusive opportunity because all of the market trends that are happening right now, we know the market is down. We describe this as the best time to get into real estate and real estate development because you're not investing for today, you're investing for 5, 6 years from now. And what that market will be, no one's got a crystal ball, but I would say that we are still able to achieve this type of return if we're including the build to rent strategy and everything that's happening in the markets today. So, and just as a quick recap, our team does have 55 years worth of experience in this space between real estate development, project management, and finance. I have one more slide here that I felt was just super important to include because you talk about real estate these days in Canada, you get some negative talk and whatnot, right? So
Just
we've
slightly.
all seen this slide before. This is the infamous slide that everyone talks about when you're talking about real estate investing. So over the last century, this trend has been very, very persistent. And we all know that we're not really exactly in euphoria stage right now. So where does that leave us? Well, I don't know. Are we in desperation? Are we in relief? I don't know. We're probably somewhere very close to the maximum point of financial opportunity. That's just my honest opinion. So again, real estate development, what we're looking to do is acquire lands at favorable pricing and be able to execute in real estate development in high growth areas. So again, no one's got a crystal ball. No one can say exactly where we are on this chart, but I think somewhere between capitulation and hope is probably where we realistically land, right? What do you think, Michael? Where do we sit right now?
Yeah, I would probably say, I mean, people are done panicking. They're kind of getting used to the fact of, everything that's going on in the world right now, economically and politically speaking. But yeah, I would say I'd have to agree. We're probably in that little bottom curve there. So you have to look for opportunities because if you don't look for them, or if you're not ready to take them, then it'll be pretty hard to get out of that curve. It's the old adage, buy when everyone else is selling and then sell when everyone else is buying.
Exactly. That's it right there. So, yeah,
It's
people that have already had fruitful returns from real estate, they know this is the time, right? But yeah, if you're kind of new
absolutely.
to it, you can be a little nervous, and I get that. So, makes a
Yeah.
lot of sense. But I felt that this was really important to include in this because it is a hot topic of conversation. Exactly.
Yes, absolutely. And real estate's one of those asset classes where it's never really a bad time to get into it, especially on a larger scale. It's one of those things that it hardly ever retracts from a value perspective. I mean, sure, single family homes, that can fluctuate a little bit. It's actually riskier to buy your own home than invest into a development, from a numbers perspective, actually.
Yeah.
But all that to say, it's never really a bad time to get in. It's just about being prepared to do it and executing. Because if you can execute, well, then you can't participate. But if you can, definitely worthwhile getting invested and getting those dollars working for you.
Exactly. So, with that, I will give just a slight summary of what I talked about today because on the Parvis site, we do have three different funds today. I'm just
Mhm.
focusing on two to keep things simple. We've got the development fund where we're looking to take capital partners and be able to engage in very lucrative types of real estate development opportunities. With the income fund, a little bit different because we're engaging your capital in a pool of mortgages, land loans, construction loans, and that can give you monthly cash distributions between 8 and 12% annual. We're very excited to have this opportunity to share our investments with everyone in Parvis community. And at this point, I would absolutely invite any questions that you might have, Michael.
Yeah, no. Well, the throughout the whole presentation, I mean, you answered pretty much all of them. The ones that I asked, well, I rudely interrupted every now and again. But at the end, I mean, one of the questions that comes to mind actually with the development fund in particular is once the development is over, who typically are the buying the folks that buy your developments? Is it something that you guys have you do the acquisition through an alternative larger fund that you guys continue on running the building itself operationally, or is it
That's
something
a
that you sell out to the open market?
great question. This is the best part about the fund model because you can have exposure to both build to sell strategy, which just literally is in open
Mhm.
for sale market in some of our developments. But then we also have the build to rent strategy, which is a very strong asset class right now. And yes, one of the exit strategies for us in the development fund is once the asset is fully tenanted, then we will just sometimes refinance all the investors out, right? So you can
Okay.
obviously sell to a pension fund or an institution, but we can also just refinance investors out and then sell the asset over to our property and investment fund where you're just participating in a REIT style type of investment over there. But we have multiple different exit strategies. So sometimes with whatever asset it might be, we'll do one and then the other in a different development. So we kind of have a blend of everything here.
Okay, excellent. Yeah, no, because I mean, personally, I work with a few investors that, unfortunately, due to some of their religious aspects, they can't invest into things that generate interest.
I
But
see.
equity is definitely open to investments there. So that's why I asked. I mean, once you cash them out, where it goes, and then so how many typically developments on average are you working on any given calendar year? Is it just so one fund per development, or is it the development fund is several different developments as you go?
Yes, great question. So it is several. This fund, we are focusing on having between 2 and 4 different properties that are for development in this fund. We are going through due diligence on 2 different properties right now. One is located in Brantford and the other one is in Cambridge. And we want to keep those last couple spots open because we know there's going to be really good acquisition opportunity over the next, let's say, 6 to 18 months. So we are kind of actively looking for another property to have in the fund as well, but we are going through due diligence on 2 different properties right now to be able to sell them to the fund, basically.
Oh, okay, perfect. And then I guess in the development fund, is there, so I guess there's already a project ongoing, like shovels in the ground and holes are being dug?
Not yet.
Not
So
yet.
not yet, but yes, we are working on that. So part of this is yes, it is a blind pool, but it is set up that you're basically entrusting us with your capital because our structure is set up that the success is shared by everyone. And my team has so much experience in this space that we're very confident we can execute in a very fruitful fashion. We just have to have a little bit of patience of yeah, about a 5 to 6 year for
Okay.
the development.
Yeah. But the first plot of land you have under acquisition, that one's already sort of zoned and everything. So I mean, it's just a question of time before all the other red tape gets settled.
They're still going through due diligence, but
Okay.
yes, but yeah, we focus on opportunities where working with the city will take a shorter period of time than others. Because you hear some of these nightmare stories where it just gets dragged along in the city. We are absolutely avoiding that. So
Oh, excellent.
yeah, yeah, kind of like I mentioned before, we have had some experience with working with the city with yeah, Brantford and Cambridge, and they are so much more collaborative to work with, and that helps with your turnaround time. So yes, we are kind of doing that, but yes, we all realize it does need to be the appropriate property, the appropriate market dynamics, employment diversification, population growth, all these migration trends. This comes into the factor as well. So we make sure that we
Okay.
are engaging the appropriate asset.
Excellent. And then as you guys move forward, so it's mainly all in the sort of the general GTA area. Is there any plans on expanding past that into other geographical areas or eventually?
Great question. So we can invest anywhere in Canada.
Okay.
We have looked at some properties out in Alberta, but then we get into the slight issue of the employment diversification thing. So we want to make sure that we do have the employment diversification because if something happens, you want to just make sure economically that you have the diversity that's all around that. So Southern Ontario just has so much opportunity right now. That's where we're pretty confident all of our investments are going to be because that's just where we're seeing the most amount of opportunity.
Very nice. Otherwise, I mean, yeah, no, I mean, I enjoy development. It's always exciting for me. I mean, it's not for everybody. I mean, if they have the runway, absolutely. As far as time is concerned, it's
Yeah,
when investors are, of more of a vintage age and they try and get into development. It's definitely riskier for them unless they want to leave it to the kids. Then it's fine. But
that's the
otherwise,
thing. We
yeah.
can always just assign the beneficiary and the account.
Absolutely.
Nice and easy.
Absolutely. I've had several that would set up they would set up little trusts for their grandchildren in the development space. So it's nice that way. But otherwise I don't think I have any other questions because the debt fund with the income generation is very, very clear. And same thing, the mortgages and the loans are all pretty much in that same general area as well.
Yes, that's exactly
Okay.
right. So my business partners have all their connections in Southern Ontario in this space. So we've got constant market demand, but that is from these areas that we kind of, our backyard. We're in Burlington here in Ontario. So that is where most of the opportunities are coming from.
Okay. Excellent. Well, yeah, no, I'm all out of questions for now. So, but I mean, if other investors have questions for Dan moving
Yes.
forward, please definitely contact myself or Dan directly. I mean, but we'll be happy to answer any questions. And but thank you, Dan, for joining us today for Brick by Brick. It was a tremendous conversation, and look forward to the next one and some further updates on the development fund.
Oh, thank you very much for having me. And yes, any other questions that your investors have, then feel free to reach out. I'm more than happy to help.
Excellent. Well, thank you so much, and
Okay.
well, have yourself a great afternoon.
All right. You too.